Okay, let's start with something bold. Imagine hearing about an 18,000% potential upside for a major digital asset. Sounds almost unbelievable, right? But that's the kind of prediction we're talking about today, coming from a billionaire investor looking at Bitcoin.
It's definitely a headline grabber.
Yeah,
18,000%.
absolutely. So today we're going to really dive deep into these pretty startling insights from tech entrepreneur Michael Saylor. We'll look at his vision for Bitcoin's future and, crucially, how something like a BlackRock ETF fits into that picture.
And we're grounding this discussion in a specific source.
Yes, exactly. It's an article from The Motley Fool written by Neil Patel, published just recently, August 5th, 2025. The title is BlackRock Bitcoin ETF, Saylor's 18,000% prediction.
A very direct title.
It is. And our goal here isn't just to report the number, that 18,000%. We want to get into the why. What's behind Saylor's thinking? Why is he so incredibly bullish?
And what does it all mean?
Yeah, and how can you, our listeners, sort of process this information, especially considering the whole financial world around us? So let's get into it.
Maybe we should start with Michael Saylor himself, because his background is quite interesting in this context.
Good idea.
Yeah.
He's the co-founder of MicroStrategy, right?
Right.
Which was, for a very long time, an enterprise software company.
Yeah, founded way back in 1989. Decades focused on software solutions for businesses.
That was their core identity. But then, in the last few years, it feels like he's completely shifted gears. The article mentions him being laser focused on something totally different.
It's a fascinating pivot. You have this established tech guy,
Right, running a long-standing company.
and then suddenly he dives headfirst into Bitcoin. What drives that kind of change?
Exactly. What happened there?
Well, according to the analysis, the turning point seems to have been the COVID-19 pandemic.
Okay.
Saylor watched the federal debt skyrocket, saw the massive increase in the money supply, and apparently came to a stark conclusion that holding traditional assets like cash or even U.S. Treasuries was essentially a losing game. He felt their value was being eroded.
Wow. Okay, so seeing that perceived erosion led to a pretty radical strategy shift at MicroStrategy.
Totally radical. August 2020 is when they made their first big Bitcoin purchase for the company's treasury.
And since then, it's like the company's whole value proposition has changed. It's not really about the software first anymore, is it?
Not primarily, no. It's driven by what he calls a Bitcoin treasury strategy.
Which, let's break that down. They're basically using traditional finance tools.
Right. Raising money through debt, so fixed income markets, and selling company stock, equity markets.
And then using that cash to just aggressively buy more Bitcoin.
It's quite something. They're leveraging their status as a public company to acquire Bitcoin systematically. It shows an incredible level of conviction that Bitcoin is, well, the superior treasury asset for the future.
And the scale we're talking about is pretty immense.
Oh, absolutely. The source, referencing BitcoinTreasuries.net, puts their holdings at just under 629,000 Bitcoin units.
629,000. That is a lot of Bitcoin.
It underscores the seriousness of this strategy. It's not a small side bet.
Clearly not. So with that level of commitment, holding all that Bitcoin, what kind of future price does Saylor actually foresee? This is where the big number comes in.
Right. He's put a target out there. $21 million per Bitcoin
$21 million.
by the year 2046.
Okay, let's put that in context. The article notes Bitcoin's price around $114,000 when it was published. So $21 million from $114K. That's a nearly 18,000% upside we mentioned at the start.
It's almost hard to wrap your head around, isn't it? It implies such a massive shift in value.
And what's maybe even more interesting is that this target isn't set in stone. It's actually increased.
Yeah. The article points that out. This $21 million figure is significantly higher than a prediction he made just a year earlier. His 2045 base case then was $13 million.
So in just 1 year, his outlook became considerably more bullish. He's doubling down, essentially.
Seems like it. And the core idea driving this, his fundamental belief, is that Bitcoin is positioned to capture a greater share of global wealth over time.
Okay, capture global wealth. Where does he think this wealth is going to come from? It has to be shifting from somewhere else.
That's the key part of his thesis. He suggests it will pull capital away from other major asset classes, things like the stock market, fixed income, bonds, even real estate.
So he sees Bitcoin basically sucking value out of these massive established markets.
That seems to be the implication, that it becomes the preferred store of value, digital property, attracting capital that would otherwise sit in those traditional assets.
And what makes him more bullish now compared to a year ago? Are there specific reasons for raising that target?
The article highlights a couple of what it calls important catalysts. First, the launch of spot Bitcoin ETFs.
Which we've definitely seen gain traction.
Absolutely. And second, the potential for, let's say, more favorable regulation down the line.
Ah, okay. So, easier access through ETFs and maybe a clearer, friendlier regulatory environment. Those make sense as potential drivers.
These factors could lower barriers to entry, make it easier for more people and institutions to invest, which would feed into that narrative of capturing more wealth.
And that brings us directly to the BlackRock ETF connection mentioned in the article's title.
Exactly. The iShares Bitcoin Trust, ticker IBIT. It's an ETF from BlackRock, a huge asset manager, and it directly tracks Bitcoin's price.
So the logic is pretty straightforward. If Saylor's right and Bitcoin itself goes up 18,000%, then an ETF tracking Bitcoin.
Should, in theory, deliver similar upside. It's designed to mirror the asset's performance.
And the appeal is obvious, right? The article calls it a hassle-free way to get Bitcoin exposure.
Definitely. You don't need to worry about setting up a wallet, managing private keys, security, all that technical stuff. You just buy the ETF like a stock through your brokerage account.
Much simpler for many investors. Though the article does acknowledge there are some differences between owning Bitcoin directly and buying the ETF.
Right, doesn't go into detail. But the main one is custody. With the ETF, you don't actually hold the Bitcoin yourself. BlackRock's custodian does. You own shares representing the Bitcoin.
So you get the price exposure, but not the direct control or, say, the ability to use the Bitcoin on-chain like you would if you held it yourself.
Precisely. It's a trade-off. Convenience versus direct ownership and control.
Okay, so stepping back a bit, we have this vision from Saylor. Bitcoin potentially absorbing huge amounts of wealth from stocks, bonds, real estate, fueled partly by easier access via things like the BlackRock ETF.
It's a compelling, if incredibly ambitious, picture of the future.
It really is, and it makes you wonder, how should our listeners think about this? If this scenario, or even a fraction of it, plays out, what does it mean for traditional investment strategies, like, the standard portfolio mix?
That's the $1 million, or maybe the $21 million question, right? It fundamentally challenges the assumptions behind traditional asset allocation. If a significant chunk of global wealth migrates to Bitcoin,
then diversification looks different. The role of bonds, maybe even real estate as a primary store of wealth, could change quite dramatically.
it forces a reevaluation of what store of value means in an increasingly digital world.
So to wrap up our deep dive today, we've looked at Michael Saylor's really audacious $21 million Bitcoin prediction for 2046.
Driven by his belief that Bitcoin will siphon wealth from traditional assets, a belief seemingly bolstered by catalysts like spot ETFs.
And these ETFs, like BlackRock's IBIT, offer an easy pathway for investors to gain exposure to this potential upside, tying directly into Saylor's macro vision.
It connects the high-level prediction to tangible investment products.
So here's a final thought to leave you with. Consider what it would truly mean if one digital asset starts significantly drawing capital away from the bedrock asset classes we've relied on for generations: stocks, bonds, real estate.
What does that restructuring of global wealth actually look like? What are the second and third order effects on markets, on economies, on how we think about saving and investing?
Is Saylor's prediction just, extreme optimism? Or are we genuinely seeing the early signs of a fundamental shift in how wealth is stored and valued globally? Something to think about.